Joined by Kieran Quaine from FIIG Securities in studio with us today. And of course, Carson Scott's still with me. Kieran, the talk of quantitative easing it comes from the worries about the double-dip recession and, of course, the deflation fears in the US economy. What are the bond markets pricing in at the moment in terms of that deflation risk?
Well, the two-year note in the States is very low, and I think it got down to 0.48 at one stage. That just signals the worries about that double dip, as you said. Low growth scenario, and quantitative easing is another solution given the cash rate's so low. The solution is if the Fed keeps buying back on the open market other securities, it puts more liquidity in the system and provides another solution for pushing the economy in a low growth phase.
Talk was that, you know, by recapitalising banks at the very start of this, that somehow that would solve all our problems. You know, banks deemed too big to fail, lifelines throwing their way, when they didn't go the next step themselves and lend. But then now you've got the talk of lending being forgiven, that is to say about $800 billion just written off on the value of mortgages that are underwater. Can you understand that banks don't begin to trust this environment as one that they should be lending on?
Well, confidence going forward is a major factor here. The bank's decisions to lend going forward are a function of confidence in the economy going forward and total return that's delivered to the banking platform. The solution going forward is for the Fed to promote confidence in business going forward, and to do it, there's only two solutions really for the purpose of the Fed. It's really keep the cash rate low, and quantitative easing is another solution. Jawboning, quantitative easing, similar situation.
It does seem that the market is pricing in some sort of quantitative easing, at least in the very last few days. Do you think they're setting themselves up for disappointment, though? Some people are saying we're going way too far on this. There's no way that the Fed will come out and announce quantitative easing restarting.
The shape of the curve, the shape of the yield curve is very important here. If we look back over a year ago, the 30-year bond itself got down to very low levels, but the 30-year bond is not replicating what the 2-year note is doing. So in the short term, the focus is quantitative easing on speculation about asset prices going forward is all about the short dates. Whereas previously, at the height of the crisis, the 30-year bond did fall very dramatically. So quantitative easing very important, but focus on where that 2-year note is. So really, the yield curve saying it's not necessarily a problem going forward for the long term as much as it was previously, but certainly in the short term, it's a level of concern is voiced by all participants in the market. Is the market setting itself up for disappointment? Quite possibly so. The equity market might well be disappointed if the volume of quantitative easing that's speculated upon doesn't occur, and the bond market itself might well be disappointed if that volume doesn't come through as well.
And the Forex market is also one that you can't ignore, because people are saying if the Fed signals they've got the finger on the trigger, that'll weigh on the dollar. So, you know, there's this constant push-pull in every different asset class, really. Constant push-pull. And how you can then, as an investor, make an allocation is the question. How much do you allocate to cash, thinking that the US dollar might tomorrow crumble? How much do you put into bonds, thinking, well, suddenly the bond market turns so bearish that, you know, it's just all bets are off? I mean, well, how are you advising clients?
Well, I've got the luxury of advising clients in the Australian market as opposed to the US market, I suppose. Advising basis US market rates is quite difficult when a lot is priced in, no doubt about that. The accrual returns for short-dated assets in the US are very low. In Australia, a lot higher, and our environment is a little bit different in terms of total return, total yield. But really, speculation about where to allocate your funds is in an investment profile with so much information, almost on the cusp, I suppose, of whether or not we'll fall in a double dip or growth will return, is always quite difficult.
But are the mechanisms in place even here? You know, we talk even about funding a Building the Nation program. The idea of, well, is it going to be an equity undertaking? Will it be sort of a bond issuance? we don't actually have a longer dated offering available for retail clients, like it or not. So the mechanisms themselves, the structure's not there. And what will it take?
Well, the structure is there in respect of asset allocation to either the bond market or the equity market through wholesale fund platforms.
But it's a very unfriendly structure. You know, to actually issue a retail bond here is fraught with difficulty. It's not a streamlined process, or is it? Correct me if I'm wrong.
No, you're not wrong. It's not a streamlined process. It's quite difficult. And various companies are making moves to increase the likelihood of a retail bond platform being established. There have been various retail bonds issued in the market, but not many, and not many long-dated ones. And of course, long-dated bond speculation about the issuance of long-dated bonds is very relevant in this environment. Should we allocate more to equities, or should an investor allocate more to equities or to bonds? In an environment of uncertainty, I would speculate that I would suggest that you're better off increasing your allocation in bonds at the expense of equities. And certainly, speculation about long-dated bonds being issued in the market's a good thing for developments going forward, infrastructure planning, and funding long-term projects.
Is there a timeline on that? Do you get a sense when those offerings might actually hit the market, that people can jump in?
On the retail, well, it's how long's a piece of string. It does take a long period of time, and the offerings will be diverse going forward, and from government-based offerings through to retail-based, through to corporate-based offerings.
And the idea of the 30-year bond market, is there kind of a checklist? You say these things need to happen for kind of that to get established?
I think the major thing that needs to happen is actually happening. There is a demand for infrastructure financing in the Australian market going forward. I mean, the debate amongst politicians at the moment about the size of the population is still raging, if you like. But going forward, in expectation of a growing population and a growing requirement for infrastructure financing, there's going to be a growing requirement for long-term bond financing to fund those infrastructure projects.
Is there though this tension between understanding just where you are when it comes to getting your money back? You're talking about, say, a 30-year horizon, and not knowing whether a company is going to be around in that amount of time. In fairness, particularly in what's been a really battered sector, if we're talking construction, when all bets were off during the GFC. Can you understand that retail investors are pretty wary about that?
I can understand that, but at the same time, the alternative is that they invest in equities, which is the highest form of risk. The alternative may be in various bond offerings that do occur, various levels of protection for those investors, various covenants in the loans that they lend into, the structures they lend into.
But say if it was a tussle between fixed income for people, where you're not taking those wild equity market gambles, versus a bond offering, how would you sell it? How would you tell me, forget fixed income, forget a nice 6% return, and hop on board on a 30-year issuance?
Well, it's about managing the profile of the risk that you wish to enter into, and in regard to the returns you wish to achieve. And really, you might invest a minor percentage in 30-year bonds. Might simply be the answer, but a lot of people could invest a lot of money in a lot of 30-year bonds, and still accumulate a significant size issue.
Kieran, we have to leave it there for today, but thanks so much for joining us today. Appreciate it.
Thank you, Brooke.
Kieran Quaine from FIIG.